Hey everyone, thanks for joining us again. Today we're looking at the chapter on probabilities. So again, very important, while we've got the descriptive stats and they're telling us, all those measurements are telling us what our probabilities are, of having a strategy that's going to win in the market and yield positive returns and things like that. It's really important that we understand what those probabilities are and what they actually mean. So a couple of the learning objectives that we're going to have to cover: obviously define probability, explain the impact of the law of large numbers on a series of outcomes, define the random variable, and the phrase independent and identically distributed. Bit of a tongue twister, that one. Describe a normal probability distribution and also identify skew and kurtosis. So we'll cover all of those as we go. So let's go and get in with the slides. All right, so the first thing that we have here is probabilities. Looking at this, so probability measures the extent to which an event is likely to occur. So if I flipped a coin, we know that I've got a 50-50 chance, unless of course the coin is weighted or something, but from a perfectly weighted coin, I've got a 50-50 chance of it being heads or being tails. So, my probability is 50-50 on that. We measure probabilities though on a scale from 0 to 1. So it's really a percentage style calculation. 0 means that it's completely impossible that I would ever get what I'm looking for, or the event that I'm talking about. If it has the probability of 0, means that it's impossible. If it had a probability of 1, then it means that it was absolutely certain that it was going to happen. But as I said, we often talk about them in percentages anyway. So it's a 50% chance of getting heads or a 0.5%. And you can see here, so something like a die, 1 in 6 chance. But if I have 5 balls and I want to know what's my probability of getting 4 of them, any one of these 4, then it's a 4 and a 5 chance of that one. So a 0.8 or 80% probability. So again, coin flip, often use this when we talk about probabilities because we just get it. Everyone understands the coin flip analogy and how that works. So again, the probability of heads is 0.5, the probability of tails is 0.5. Ideally, when we talk about probabilities, everything should add up to 1. So, if I had 4 options, then each of them would be 0.25, but it all adds up to 1 as well. And that's an important thing to really understand here. When we talk about these probabilities, if I flipped a coin and I'd flipped it and I got 10 heads in a row, does that mean that I've got a higher probability of getting a tails? No, it doesn't. Each flip of that coin is still independent. It's independent of what's gone on prior to that. So we call it an independent and identically distributed test. Well, the independent part basically means that the flip is not affected by what happened before. Now, whilst I wouldn't say that markets are completely independent, there is an element of this which is still true. Unless we get into this massive overbought or oversold style type of scenario, when we go and take a trade and we take a strategy, we basically are almost independent. What happened beforehand really has no bearing. Now, particularly if I was working a strategy and I was taking different trades in different securities, and if I'd had 10 losses in a row, that doesn't mean that I've now got a higher chance of getting a win. It means I still have the same probabilities that I calculated of winning, as I put this into practice. This whole thing, but as people, as one of our biases, is that we seem to think that, just because I've had 10 losses in a row, I've got to win this time. The casinos do it as well. The casinos put up on boards what the last payouts were and things like that, because most gamblers just can't get away from that fact. They're biased by that information that makes them trade or gamble in an unrealistic way because they're expecting it's got to work now because it didn't work for the last 10. So again, that's very important. So independence means that prior flips or prior trades have no effect on the current one. Identically distributed means that if I had two coins and I was flipping them both, that they are identical coins. They both have the 50-50 chance of yielding heads. And it doesn't have to be balanced. You know, it could be a 70% chance. Maybe they are weighted, but the two coins are identically weighted then. So independent and identically distributed is telling us that. All right, so remember that IID, for shorthand, is an assumption of many statistical calculations. Lots and lots of research done in finance tells us that stock prices are not independent and identically distributed. So, you know, that's again this case. When we do get into these overbought and oversold scenarios, we do start to see a higher probability that the market will turn. So everything that I said before about gambling and coin flips doesn't necessarily apply to like an individual stock and the returns, because we do have this scenario. There's the group biases. At the end of the day, I still often think about technical analysis as it doesn't drive the market. Fundamental analysis drives the market. But technical analysis is all about finding those cues, those keys that help us take advantage of what's happening in the market. So again, we have to understand the behavioral concepts. We have to understand the behavioral biases that drive so many investors. And the reality is that when we are in major oversold territory or major overbought territory, there is such a push. You know, there's a lot of people who will say, that's it, the market's as high as it can go, it's got to go down. And as soon as they start to see some downward movement, bang, they're on board. They're jumping onto that. So, you know, it's a very important thing. Now, in contrast, a dependent event, so we said that those events were independent, meaning that the probability doesn't change based on what had happened in the past. Dependent events are like if I had a bag of marbles, lots of blue ones, some red ones, what's my probability of pulling out a red one? But when I pull the marble out and calculate it, I then put it aside. I don't put it back in the bag. That means that every time I go in, my probability of getting a red marble changes based on what I've just taken out. So that's an example of a dependent event. All right, basic probability concepts. Getting into a lot of words here on this slide. A single trade is obviously an unpredictable event. You know, the reality is we do all our measurements, but we go in, we take a trade. There's a certain amount of unpredictability about what's going to happen. We have a range of expectations, but how well that's going to work, you know, we don't know. We hope to stay within that range, but again, we may be facing an outlier event. It could be a massive loss or a massive windfall due to something happening and we were just lucky or unlucky to be in that trade at the time. But it can fall anywhere in our observed range. That's the point there. That's a single trade. But when we go and do that strategy over and over and over and over again, then it starts to become more regular and more predictable. It's like a coin toss. You know, I can toss a coin and get tails. I can toss it again and get tails. You know, that's not a 50-50 distribution. But as I go and I go and I go and I keep testing and testing and testing, it converges on that 50% or 0.5 probability that we would expect. And this is the model that casinos use. You know, this is actually casino business management 101. You know, you want to find a game that just has that probability weighted in your favor. And then it doesn't matter if some individuals win big. For the most part, with so many games being played, so many trades happening in the market, we get back to those averages. And so, yeah, that's why this is so important. Probability of any outcome of a random phenomenon is the proportion of times the outcome would occur over a long time. So there's a bit of a formula here, a little bit different than how it's represented in the CMT book. I just feel this is a little bit clearer. So the probability of X happening is the number of times X occurred divided by the total number of times that we're sampling or testing, as possible. So over the past 20 years, there have been 1,000 instances of a technical analysis signal, and in 700 of those instances, the market moved higher over 10 days. So our conclusion from that is that in the future, there is a 0.7 or 70% probability that the market will be higher 10 days after this signal. So again, that's how we would define that. So the random variable, basically that probability is what we call the random variable. So if you ever hear that talked about, anything like the px that we have there, that's the random variable. It's the result of a probability function is really what it is. So again, this definition, random variable, usually written x, is a variable whose possible values are numerical outcomes of a random phenomenon. Don't you love these theoretical definitions? Basically, it's really just the px or p heads or whatever. That's what the random variable is. Over many measurements, like coin flips, etc., the law of large numbers takes effect and the results will converge on the expected probability. So now just shifting into the probability distribution, when we talked about stats, we talked about averages and the need to look at visualizations, we talked about a distribution. Again, now going back to the probability distribution, looking at that in a little more detail, we can put any measurement in here. We can do profits, we can do, returns and profits are the same, but we can put lots of numbers into something like this. And it gives us a clear picture of how the results are distributed, whether the results are nicely distributed around our average or whether they're spread out because they've got massive fat tails, etc. We can also see the exact probability of any desired return. So for instance, if I had this return from a strategy and I had a client that sort of said to me, hey, I want 40% or better returns, well, I can count what the probabilities are for each of these going forward. And I think in this chart, it's a little detailed. So in stats, I presented a chart there and I said, okay, the bins are 1%. In this one, the bins I think are 0.5% bins. So they're a little bit smaller. But anyway, I can count going forward all of those results and then say, okay, well, here's the probability that you're going to get your desired return, something over 40%, or I could do an exact number and say, okay, well, what's my probability of getting exactly 20%? Well, it's, within about 0.75%, something like that. Which seems very small, but then again, that's because we're using small bins. That makes those numbers smaller. The more data points we add, the more the distribution takes on the bell curve shape, which is the standard Gaussian normal distribution. So again, normal distribution here, best known as the bell curve, or Gaussian distribution is another name that it's often referred to. Many measurements tend to be normally distributed, meaning that you take measurements of people's heights, you're going to get an average height, and you're going to find there is a distribution, and it's pretty even on both sides. That when you get like 1 foot taller and 1 foot shorter than the average, that that's pretty much around about the same coming up to them. When we talk about stock price returns and things like that, daily returns, that doesn't follow a normal distribution. That's usually skewed more, and we'll show an example of that in a moment. Log normal distribution is actually the way that we would describe stock price returns. It's used a lot in finance, and the reason being is that typically if I invest, my loss is limited to 100% loss, but my possible gains aren't limited. I could be so successful or get one of those lottery trades and have these massive returns. They do happen. So again, that's where we look at the log normal distribution. I don't think, when you talk about CMT, that you need to know much more than the fact that it actually exists. The only thing to note is that our median is pushed off to the right when you're looking at a log normal distribution because there's so much more happening way out here. Other thing just to note is a uniform distribution is the other term you may hear from time to time, and that's like flipping a coin, rolling a dice. You know, at the end of the day, it's not going to be, you know, if I rolled a die, I'm not going to suddenly have a peak at the number 3. You would expect, if it's a properly weighted dice, that it's going to be flat. It's like 1 has the same probability as 6 has, and 2, 3, 4, 5, etc. So that would be a uniform distribution. So you may hear about that as well. So the moments. Now, so again, talking about the averages being bad and wanting to have better numbers to describe them. So we have the probability distribution, but there's a few numbers that we use to describe that and describe the probability distribution that we're looking at. So we look at what we call the 4 moments of a distribution. Now, the mean we know about. That's just the average here, or X bar. The second moment is the standard deviation, which is what's our dispersion around the mean. And so we have that there. And then we have skewness. Now, skewness tells us how uniform the shape is, or is it skewed to the side, either positive or negative. And then the fourth moment is kurtosis. And that tells us how peaked, the measurement. There's a little bit of confusion about this because there's a lot of people that talk about kurtosis telling us how peaked the distribution is, and that's true, it does, but that's more of a correlation. The actual thing that it's really telling us is how much our results are affected by outliers and how many outliers are in the result set, which is skewing the results there as well. Skewing probably was a bad word to use. Affecting our results would be better. So skewness, it tells us about the relationship between the mean and the mode. So when we get a situation here like this, it's called negative skew because our mean is probably here. The average result's here, but the most common result was back here. And so we take the mean value, we subtract the mode value, and because the mode's bigger, that gives us a negative number, so it's a negative skew. Here's the other case where our average may be here, the mode, I should say, is back here. Mode is always the peak. And so we say that's positive skew in this case. It's not, when it comes to finance, it's not that one's better than another. Again, it's just things that we need to be aware of about this. So the actual calculation of the skewness number is the mean minus mode divided by the standard deviation is how we calculate that. In our tests, we often have positive skew because of that issue that our downside is limited to 100% loss, but upside is unlimited. Kurtosis is the other one. So it measures the degree to which the returns show up in the tails. So that means that we've got fat tails or long tails. It means that yes, we have this average, and yes, we've got results around there, but the reason it's gotten so peaked is because so much of our results have ended up in tails and we've got huge gains. So again, like we had with our averages in the stats introduction, where we talked about that 175% return, which basically pulled us out of having negative results. In a similar way, that would have had a really high kurtosis result because it's relying on this massive outlier. So we don't want to see massive kurtosis numbers. We really want to see that to be pretty low. And so again, as we get into system testing and quantitative methods, these numbers come up as well. Normal distribution has a kurtosis of 3. That's just something to remember. So the normal curve here in the middle, that would be a kurtosis of 3. Sometimes people talk about this as excess kurtosis, and really all they're doing is subtracting away the 3. So if I had a kurtosis value of 4, then excess kurtosis would be 1 in that case as well. All right, so that is an introduction to probability, defining what probability is, explaining the impact of large numbers. The more tests we do, it brings those results closer and closer to the expected probabilities. Probabilities really are mostly valid, or you know, they occur, we converge on the probability when we have lots and lots of tests and lots of values to work with. The random variable is obviously just that probability number. Independent, identically distributed. Independence means that our next result is not affected by the results that we just had. Identically distributed, that each time we go in, you know, we have the same probabilities of each of those tests. Normal probability, you know, skewness and kurtosis as there. Make sure you understand those as well. So that's an introduction to probability, and we'll continue next time. Thank you.